There is one investment so simple, so boring, that Wall Street almost never talks about it, and yet it quietly beats the vast majority of highly paid professional investors year after year after year. It requires no special knowledge, no stock picking, no watching the market all day, and no luck. The greatest investor of all time, Warren Buffett, has said that for most people, this is the single smartest way to invest, and he's instructed that most of his own money be put into it after he's gone. It's called an index fund, and once you understand it, you'll never look at investing as this scary, complicated thing for experts again. In the next few minutes I'm going to show you exactly what an index fund is, the myths that keep regular people out of the market, the almost unfair data behind why it works so well, and the honest caveats you need to know. Then I'll show you how to actually buy one and set it on autopilot, starting tonight. If you've ever felt like investing was a rigged game you weren't smart enough to play, this video is going to change that completely. So stick with me. Welcome to Money Decoded. So let's demystify what an index fund actually is, because the name sounds more complicated than the idea. Normally, when people think of investing, they picture trying to pick the one winning company. Should I buy this stock or that one? Will this company go up? That's stressful, it's risky, and honestly, most people, even professionals, are bad at it. An index fund flips that entire game on its head. Instead of trying to pick winners, an index fund lets you buy a tiny slice of hundreds or even thousands of companies all at once, in a single purchase. For example, a popular index called the S&P 500 tracks about 500 of the largest companies in the United States. When you buy an S&P 500 index fund, you instantly own a little piece of all of them: Apple, Microsoft, Coca-Cola, hundreds of the biggest businesses in the country, all in one go. You're no longer betting on one company. You're betting that the overall economy, the collective power of hundreds of the best businesses, will keep growing over time, which historically it always has. That's the whole idea. You stop trying to find the needle, and you just buy the entire haystack. It's diversification and simplicity in one move. But there are some very expensive myths that keep people from doing this. Let's tear down the myths that keep regular people sitting on the sidelines while their money loses value to inflation. Myth 1, you need to be an expert to invest. Not with an index fund. The entire point is that you don't pick anything, you just buy the whole market and let it grow. It's arguably the least expert-dependent investment there is. Myth 2, I need a lot of money to start. False. These days you can often start with very little, even a small amount each month, because many funds let you buy fractional shares. Myth 3, investing is basically gambling, I could lose everything. Here's the key difference. Betting on one random stock can go to zero. But a broad index fund is spread across hundreds of companies, so for it to go to zero, essentially the entire economy would have to collapse permanently, and if that happened, we'd all have much bigger problems than our portfolios. Individual companies fail, the broad market as a whole has always, eventually, recovered and grown. Myth 4, smart professionals with fancy tools will do better than me. This is the big one, and the data on it is genuinely shocking, so let me show you the numbers, because they're the whole reason this works. Here's the fact that Wall Street would rather you didn't fully absorb. Study after study has shown that over long periods, the large majority of professional, actively managed funds, run by highly paid experts with teams of analysts, fail to beat a simple index fund. We're talking something like 80 or 90% of them underperforming the index over long stretches of time. Read that again. Most of the pros, with all their tools and salaries, lose to a boring fund that just buys everything and sits still. Why? Two big reasons. First, consistently predicting winners is incredibly hard, even for smart people. Second, and this is huge, those active funds charge high fees for all that effort, and those fees quietly eat your returns every single year. Index funds, by contrast, are what's called passive, so they charge tiny fees, often a fraction of a percent. Over decades, that fee difference alone can mean tens or hundreds of thousands of dollars staying in your pocket. And the growth itself is remarkable. Historically, a broad US index has averaged somewhere around 7 to 10% a year over the long run. Thanks to compounding, that can turn modest, steady contributions into a genuine fortune over a working lifetime. Simple, cheap, and it beats the experts. But I have to be honest with you about the fine print, because there's a twist. Here's the honest fine print, because I will never pretend investing is magic. First, and most important, the market goes down, sometimes a lot and sometimes for a while. In any given year, a broad index can drop 10, 20, even 30 or 40%. That is normal and expected. The catch is that the incredible long-term returns only come to people who stay invested through those drops. The single biggest way people lose money in index funds is by panicking when the market falls and selling at the bottom, locking in their losses. The market has always recovered eventually and gone on to new highs, but only patient people captured that. So this is long-term money, ideally 5, 10, 20 years or more, not cash you'll need next year. Second, past performance doesn't guarantee the future, those historical averages are a guide, not a promise. Third, not all index funds are equal, you want a broad, low-cost one, so always check the fee, called the expense ratio, and keep it low. And fourth, remember this is the investment you put inside accounts like a Roth IRA or a 401k that we've talked about. The account is the container, the index fund is what grows inside it. With all that understood, let's actually buy one. So here's the first move, pick a broad, low-cost index fund. You do not need to overthink this, and you do not need dozens of funds. For most people, one simple, broad fund is genuinely enough. The two most common, trusted choices are a fund that tracks the S&P 500, giving you the 500 largest US companies, or an even broader total stock market fund, which owns essentially the entire US market in one shot. Either is an excellent, boring, effective choice. When you're comparing options, the most important thing to check is the expense ratio, which is the annual fee. You want it to be very low, ideally well under 0.25%, and the big reputable providers offer exactly these at rock-bottom costs. Now, where do you buy it? Inside an investment account. If your employer's 401k offers a low-cost index fund, that's a perfect place, especially up to your match. A Roth IRA is another ideal home for it, because of that tax-free growth we covered. Or you can use a regular brokerage account. The account is the container, the index fund is what you buy inside it. Pick your broad, low-cost fund, and you've made the single most important decision. But buying it once isn't the strategy. The real power comes from the second move. The second move is what actually builds wealth. You automate your investing, and then you leave it completely alone. Set up an automatic transfer that buys your chosen index fund every month, whatever amount fits your budget, even $50 or $100 to start. This does something powerful called dollar cost averaging, because you're buying automatically every month, you buy more shares when prices are low and fewer when they're high, all without you having to guess or time anything. It removes emotion entirely. Then, and this is the hard part for most people, you do nothing. You don't check it every day. You don't panic when the news is scary. You don't sell when the market drops, in fact, drops are when your automatic contributions are buying at a discount. The most successful index investors are almost boring on purpose, they buy the same broad fund, automatically, month after month, for decades, and they simply let compounding do the heavy lifting. The people who tinker, who jump in and out, who chase hot tips, almost always do worse than the person who set it up once and forgot about it. Wealth here is built through patience and consistency, not excitement. So let's turn all of this into action you can take tonight. Let's make this real with 3 moves. First, make sure you have an investment account. This could be your 401k at work, a Roth IRA, or a regular brokerage account with a big reputable low-cost provider. If you don't have one yet, opening a brokerage or Roth IRA takes about 15 minutes, and I've covered those in detail in other videos. Second, choose your fund. Pick one broad, low-cost index fund, either an S&P 500 fund or a total US stock market fund, and double-check that the expense ratio is very low. Don't agonize over which of the two, they're both great. Third, buy it and automate it. Make your first purchase, even a small one, then set up an automatic monthly investment into that same fund so it keeps buying without you lifting a finger. That's the entire strategy. Account, fund, automate. If you can only do one thing tonight, make your first small purchase of a broad index fund, because getting started, and starting the clock on compounding, matters far more than the amount. Everything else you can scale up over time. The important thing is to finally be in the game. Let me leave you with the mindset shift, because it's the whole secret. In investing, boring is beautiful. The financial media makes money by making you feel like you constantly need to be doing something, buying the hot stock, reacting to the scary headline, timing the perfect moment. But the truth, backed by decades of data, is almost insultingly simple: buy a broad, low-cost index fund, keep buying it automatically, and leave it alone for a very long time. That's it. That quiet, unexciting strategy beats the vast majority of stock pickers and highly paid professionals. You don't win at investing by being the smartest or the most active. You win by being patient, consistent, and disciplined enough to do nothing when everyone else is panicking. Time in the market beats trying to time the market, almost every single time. You now understand something that puts you ahead of most people who think investing is some exclusive club they're not smart enough to join. It isn't. The door is wide open, the tool is simple, and it's available to you tonight. Be boring, be consistent, and let compounding quietly make you wealthy. And speaking of compounding, if you truly want to feel why starting today matters so much, I've got the perfect video for you next. So let's bring it home. An index fund lets you buy a tiny piece of hundreds of companies in a single move, so instead of trying to pick winners, you own the whole market. It's simple, the fees are tiny, and over long periods it quietly beats most professional investors. The honest catch is that the market goes down sometimes, so this is long-term money, and the real winners are the patient people who automate their buying and refuse to panic sell. Pick one move from this video and do it tonight, just one: open an investment account, or choose your broad low-cost fund, or make your first small purchase. Now, everything about why this works, the reason a boring index fund can turn small, steady contributions into a fortune, comes down to one force we keep coming back to on this channel: compound interest. If you truly understand how compounding works over decades, you will never want to wait another day to start. I broke it down completely in another video, and it's the perfect next watch. Go see that one right now. Subscribe to Money Decoded USA. Real money help for everyday Americans, no hype. I'll see you in the next one.